It's important to note that the economic environment is expected to be unstable in 2023, so investors will need to be courageous, patient, and nimble in order to find the best opportunities in the new year. According to BlackRock, Goldman, JPM, and others, there is a significant possibility that the U.S. will enter recession in 2023 due to the pace and intensity of Federal Reserve tightening and other factors like the supply chain, China, and war in Europe. However, the consensus is that it will be a light recession given healthy household balance sheets and resilient spending. Even if a recession can be avoided, the economy is expected to grow at a small 1% annual pace in 2023. Inflation is expected to decrease by half from a projected 7.7% rate at the end of 2022 to a 3.5% rate in 2023. The federal funds rate is likely to be in the 5% range by the time the Federal Reserve stops raising interest rates, which may occur in the second quarter of 2023, up from 0.25% in March 2022. Even though China is no longer under lockdown, the spread of COVID-19 seems to mirror March 2020 in the rest of the world in terms of the spread of infection. This will leave China in a new form of isolation for at least the first quarter of 2023. It's also a good idea to prioritize companies with consistent earnings and good profitability, as well as generous and growing dividends. Defensive sectors like utilities and consumer staples may not be the best options at this time, but healthcare can offer both growth and defensive characteristics. Value-oriented companies and small-cap stocks, which have been underperformers in recent years, may also be worth considering. These sectors, which include energy, financials, industrials, and materials, tend to be classified as value plays. Given these factors and the uncertainty in the markets, I'd like to share my top 5 picks for stocks to buy in 2023 and discuss why I believe they each have the potential to perform well in this economic environment. These names are not intended to make up a diversified portfolio. They range in size and industry. You may agree or disagree with my picks, however. I think we can both agree that we all should think about what gives us the best shot to profit from the transition from a bear market to a bull market in 2023. Number 1. Amazon.com. Market cap $943.6 billion. Stock circling mid-$80. The e-commerce and cloud computing powerhouse is currently inexpensive. A good rule to live by is to consider companies with favorable fundamentals that have in the short term seen a decline in expectations and valuations. Amazon.com is an example of this, as its stock has decreased 46% in the past year. Is this once popular growth stock now a value stock? Compared to previous levels, shares are inexpensive. At $80, Amazon stock is trading at 45 times the projected 2023 earnings, but its historical 5-year P is 73. The company's strong position in its core markets has helped it achieve a spot on this list of the best stocks to buy in 2023, even though a recession may hurt short-term profits. In terms of expectations, let's see if we see an increase in the share price to $140, which is the annual cost of Amazon Prime now and would represent an estimated upside of more than 51%, following a sum of the parts analysis. Number 2. AMD, $115.5 billion in market value. Don't fully avoid technology or the market's growth-oriented segment while changing your portfolio to incorporate the finest stocks for 2023. Tony DiSpirito, Managing Director and Portfolio Manager at BlackRock, advises using a barbell strategy. In the barbell strategy, investors purchase both short-term and long-term stocks, but not intermediate-term stocks. The particular distribution on the two extreme ends of the maturity and valuation timeline creates a barbell shape. The strategy offers investors exposure to high-yielding stocks while limiting risk. This enables you to buy value-oriented equities at historically appealing relative price-to-earnings ratios (PS) and high-growth firms at prices that have fallen from astronomical heights and are now at normal, if not still underpriced, levels. Since businesses will continue to invest in hardware and software to combat rising labor costs, these companies with excellent balance sheets will need to turn to AMD. Leading semiconductor producer Advanced Micro Devices (AMD) $60 a share has received mixed reviews from analysts, in part because short-term roadblocks including the economic downturn and unfavorable investor sentiment exist. The shares are currently trading at 18 times the anticipated earnings for the coming year, which is more than half the median price earnings multiple for the past 10 years. The shares have decreased by half from their 52-week high. According to S&P Global Market Intelligence, analysts anticipate annual earnings to increase by an average of 28% over the course of the next 3 to 5 years, outpacing peers of the company in part due to market share gains for its data center chip sales increased by 45% in the most recent quarter compared to the prior quarter. The semiconductor company is rated as a buy by analyst Vijay Rakesh of Mizuho Securities USA, who recently set a $95.50 price target for the shares for the next year. Number 3, Workday. Market cap, $45 billion. Stock, $160. Workday is a pioneer in cloud-based human resources management software. Based on its proprietary technology, it has truly been able to establish a solid position, according to Lori Keith, co-manager of the Parnassus Midcap Fund. I've used their product and they're horrible, but if your company uses it, you have no choice. Its platform is used by half of the Fortune 500. Customers also have a tendency to stick around after being installed because migrating off would be extremely costly. As such, Workday boasts a 95% client retention rate. Like most tech companies, the stock has been declining all year. Additionally, Workday barely made a profit during the previous fiscal year ending in January. But according to analysts, that will start to change in 2024, helped by a projected sales growth of about 20% in 2023 and 2024. Investors looking for the top stocks to purchase in 2023 may want to think about holding this one for more than a year. In fact, over the next 3 years, the stock's potential reward will likely outweigh its potential risk. Number 4, Merck. Market cap, $281.2 billion, 2.7% dividend yield. Why is Merck MRK, $110 a share, one of the top 5 stocks to purchase in 2023? The pharmaceutical behemoth is renowned for its excellent returns during the last 10 years. Analysts are optimistic about Merck, with a consensus rating of buy and 11 of 26 analysts rating it as a strong buy. Credit Suisse analyst Trung Nguyen has an outperform rating on MRK and believes the company's high, consistent earnings growth and low-risk growth make it a good choice for defensive investors. Nguyen notes that Merck's key assets, cancer drug Keytruda and HPV vaccine Gardasil, are well established and less affected by healthcare reforms under the Inflation Reduction Act compared to competitors. And finally, number 5, Lululemon Athletica. Market cap, $41.6 billion. Lululemon Athletica is a retailer of leisure clothing. Despite a 19% drop in its stock price over the past year, the company saw a 22% increase in comparable store sales in the last reported quarter compared to the previous year. The current price-to-earnings ratio is 28, which may seem expensive, but it is lower than the 5-year forward P ratio of 43. August research analyst John Stashik believes that Lululemon's strong brand and growing direct-to-consumer sales will lead to higher margins in the coming years and sees the recent sell-off as a buying opportunity, maintaining a long-term buy rating on the stock. Let me share a bonus pick. Archer Daniels Midland. Market cap, $51.2 billion, with a 1.7% dividend yield. Archer Daniels Midland ADM, stock price of $96, is a food commodities company that is known for buying, transporting, and processing food products. In the last year, ADM has seen success due to supply chain disruptions and rising prices. The stock is reasonably priced at a price-to-earnings ratio of 15 and is considered a good inflation hedge. According to August research analyst Taylor Conrad, ADM's strong recent performance and expectations for growth in the oilseeds business and improvement in the origination and nutrition division make the company a good long-term investment. Additionally, ADM has a strong balance sheet and a history of consistent dividend increases, making it one of the best dividend stocks to own. I can't resist a second bonus pick of Amgen. Market cap $154.5 billion, 3.1% dividend yield. Amgen is a biotech company that has been performing well due to strong sales of new drugs, but has seen slower sales for older treatments. Despite this, it is still considered a defensive stock due to its diverse portfolio of drugs, solid cash flow, and a 2.9% dividend yield. Morgan Stanley recently upgraded the stock to a buy rating, citing the strength of the company's pipeline and the stock's undervalued price. Amgen shares have gained 28% in the past year but currently trade at a P/E ratio of 14 for 2023, which is lower than the typical P/E ratio of 70 for biotech firms. Amgen is considered one of the top stocks to buy in 2023 due to these factors, and so I slipped it in as a bonus pick. And there you have it, my top 5 picks of stocks for 2023 with 2 bonus picks thrown in for your consideration. Here's hoping we're bottoming out. Do you think there'll be a start of year rally? Do you have a pick you'd like us to know about? Let the community know in the comments. Until next time, remember to like and subscribe in order to maximize your wealth and minimize your financial stress.